got a lot of information to cover. Really long 2 hours here. So first part of this hour, we're going to have Jeremy Kloter and also his sidekick. They are with Outvast Real Estate Investment, or also another real estate investment firm. We're going to talk about some of the new things they're up to. We're going to also talk to Sarah Cricky at the bottom of the hour. And what is the mortgage market doing? What are rates doing? What you can expect to see in the coming months ahead. And then hour 2 at 9 a.m., we're going to be talking all about how to clean your home for COVID-19 so that it's actually sterilized. And also, we're going to talk about with Aaron Davis about how our industry is changing very, very quickly to do 100% paperless closings. Everything from the e-notarization to the actual closing documents. And so this is something that was kind of already on the real estate radar for a long time. And now they're pretty much expediting that plan, as you can imagine. So good morning, gentlemen.
Well, hello. This is Leo King with Barrel Engineering and Inspection. Protect what matters most to your family. Adam?
Good morning, Adam Talley Insurance. Good to be back in the studio this week.
And then we're joined by our guest this morning, Mr. Jeremy Kloter, friend of Tampa Home Talk. How are you?
Hey, doing well, everyone. Thanks for having us.
And we also have, is it Edwin Epperson III? Is that right?
Yes, ma'am. Thank you for having us.
You're welcome. Good morning. So we got a lot of stuff to cover this morning. So we'll jump on into Jeremy Kloter. He is property manager with Outvast. And just curious, in your world, Jeremy, what kind of stuff are you seeing now? What kind of changes are you seeing in the moratorium on like evictions and that sort of stuff? Like, what role is that playing on any properties that are not yet leased? Just kind of curious what you're seeing on your side of the fence these days.
Yeah, great question. So we currently are managing Hillsborough and Pinellas County is kind of where we stick to. And yesterday I was reading an article from the National Association of Residential Property Managers, NARPM, and they put out some good guidance. And part of it was taking a look at what can we do when it comes to late rent, late fees, and what we can and cannot charge over the next couple coming months within the industry. What we've been seeing so far on vacancies that we have, we actually haven't seen really any slowdown. We've signed a couple leases this week. Now, that's obviously subject to change. I still hope that tenants stay on April, but I am expecting maybe some more issues with May, depending on how long people are becoming unemployed or dealing with that. So we're able to communicate to tenants, hey, if you are having trouble with income, there's assistance out there that you guys can be aware of. So just communicating with tenants and others, kind of the expectations of what we're seeing. And if tenants are reaching out and being proactive, like, hey, I might be a little bit behind, or I might be able to do a partial payment, just trying to work with them with the current environment. And then for maintenance and stuff like that, it's kind of a different dynamic too. Okay, what's an emergency, what's not? Like, what do we really need to fix to try to keep the human contact down as much as possible? So it's created some challenges, but at the same time, it's a good opportunity to evaluate the systems that you have, and it creates additional chances for opportunity through different challenges that we're working with.
Right. So are you seeing a slowdown of anybody that's saying, hey, I can't pay my rent right now? Or are you seeing a big influx of that, or not yet?
Not too much. I've only had, we're close to about 100 doors now that we manage. I've only had, I think, 2 or 3 tenants that have reached out and proactively communicated, like, hey, I might be a little bit behind, or I might be able to get caught up in May. But that's what we've seen so far. Now, hopefully some of the Section 8 and subsidized housing payments are still coming on time, but those might also lag a little bit from the local housing authorities. And sometimes, those are a little bit more, guaranteed type things. So hopefully those still aren't a delay as well. But we haven't seen too much now. But at the same time, the first is a couple days away. So we'll know shortly.
That's what I'm thinking. And just out of the few that you've seen, I'm just curious, what lines of work were they in?
I think one guy was sales. Another one I know was, I know him and his wife, I think, did a lot of Ubering and ride-sharing stuff. Is how they made most of their income. So obviously, that's an issue because you got a lot of people coming in and out. And then the third one I forget off the top of my head, but we have had some people. So when we've been doing some screening, and people are wanting to move, we're just really making sure that they're still employed, even if they have recent pay stubs and stuff like that. And then also taking a look at just being mindful of the industry that they're in. as well, and stuff where we may need to get a little bit more of a higher security deposit on the front end, or just the overall picture to make sure that, hey, in a month we're not having to deal with stuff.
We've seen the same thing on the buyer side. It's no longer, hey, are you qualified and are you pre-approved? It's what line of work are your people in and how secure is their job?
Right, yeah, especially before you run them around to a bunch of houses.
Well, we're seeing buyers still make offers on stuff. We still have, believe it or not, some relocation people still. I mean, we've had some this month. We've got more coming next month. So it's interesting to see how this is going to shake out. I do hope it passes sooner rather than later. And again, I kind of wish everything had shut down a little bit sooner. I think it would have shortened the delay we're going to experience. But I think that we'll be back in operation by Easter is super hopeful and optimistic. What do you guys think?
Extremely optimistic, I would say.
Yeah,
that's a cartoon level of our optimism.
Look, that wasn't my comment. It was the federal government making a lot of those comments. So.
If that happens, then collectively we just threw our hands up and said, I can't do it anymore, and walk away.
Scrooge is going to get us a turkey or a ham. Go down to the store and get me the big ham in the window.
Don't hold your breath, Leo. So, Jeremy, it's interesting. Tell the person listening what else you guys are doing. Like if someone has a vacant property and maybe they were ready to rent it out and now they, with everything going on and the moratorium for evictions, maybe they're like, maybe I should just wait till this passes. Maybe I shouldn't. Maybe I need the income. What advice would you give for that person? And also tell a little bit about what you do to make sure you're getting an amazing tenant that's still going to pay the rent on time, of course, God willing, they have their job, and how things progress.
Yeah, so, I mean, people are still going to have to move regardless of what's going on in the economy. So for us, it's really just business as usual. Most of the property management industry can be run pretty virtual. So I would say keep marketing your properties, whether you plan to not really fill it right now. Keep it out there so that you can screen the leads that are coming in and have your system of like the criteria that you're consistently looking for to make sure that you don't run into any fair housing laws and stuff like that. But for us, it's been for the screen side of it. We're looking at credit, we're looking at income, criminal history, watch list, past evictions, delinquent accounts, previous addresses, social security numbers. So when we employer references, landlord references. So like when someone applies and they put all this through, our software does automatic checks on verifying that social security number matches and all this stuff. And then something as simple as making sure that the pay stubs actually match the driver's license of the person that's applying. So then you're just not throwing someone else's pay stub that they found on Google into your application and take an overall picture. But I think it's for people that are having vacancies that they need to fill, keep marketing the property. Just try to move forward as much as you can with the restrictions that we may or may not have on being able to go out. But for us, it's, you have lock boxes. There are programs that also allow you to do, tenants do self-showings. So if the property is vacant, there's software where the tenant can submit driver's license and stuff, go take a look at the property without anyone else having to be there, which is becoming more common with some of the institutional-sized property management companies. And that way you really don't have any human contact, and you could always talk with them on the phone as far as how was the unit, what did you think. So there's still ways to work around not having that the person-to-person contact if that's being an issue.
So a couple questions before you get too far down the line. You talked about a watch list a second ago. What is that for the person listening? Because they might not be familiar with what that is, combined with everything else you just said.
Yeah, it's basically if there was like a terrorist watch list or anything that's in that realm, it would pop up like, hey, this person may be something that you want to check out. We've never had it come up, but it's just something that's additionally scanned on the background side of things for applicants that do apply.
And then you were talking about the lock boxes for the self-showings and the software. So for the person listening that has some concerns about the safety and also their property being secured correctly, you want to chime in on that real quick? We only have about 30 seconds.
Yeah, so I think having some cameras on the outside will help, but then obviously just screening and having a conversation with who's coming into the property. We don't personally do the self-showing stuff, but I just know it is an option. And yes, there is some additional risk, but I believe that most of them require some type of form of payment, driver's license and stuff like that before they can actually get in. So it would be foolish of them to try to actually do something to the property.
Right.
And most of the time,
right,
you know,
Jeremy.
they'll have to go through a lot of effort to steal anything out of it. But
Hang tight. We'll be back with you on segment 2 in just a minute. We're also going to join Edmund. We're going to talk about some of the new things that you guys are involved with. Stick around. We'll be back in just a moment.
sure.
Okay, here with Beryl Engineering. I'm joined with Katrina from Tampa Home Talk and Adam from Tally Insurance.
You actually beat us both in the studio again.
Oh yeah, well there's no traffic on the road. It was a breeze. I guess, Pat, are we seeing a lot of traffic on the road nowadays?
He's worried if he could have a job, but he can get the traffic out.
Yeah. You know,
Hey, I'm here in case it happens.
social distancing if you're in the helicopter.
Well, let me tell you, there's safe distancing and on the Gandy, on the Howard Franklin, and the interchange right now. 275, absolutely a little slow coming through westbound I-4. Kind of in your neighborhood there, Leo. I-4 and the interchange, so watch out for that.
I want to jump right in. I want to bring Edwin, a good friend of mine from several years back. Edwin Epperson III. He is the president of DePuy Capital Group, and I really want to bring him in on basically this investment opportunity and have him talk a little bit about that. What do you think, Katrina?
Yeah, what are you guys doing? What are you up to?
Well, thank you very much, Leo. It was good to hear from you. It's always great to see you. Sorry we couldn't be there in the studio with you guys this morning. Katrina, great meeting you, and thank you for having us on.
Same here. We missed our guests being in the studio weekly, don't we, guys?
Oh,
we really
yeah.
miss them.
Definitely do.
We'll have to do it again in the future.
Yeah, the last people we had in the studio
There
were
we go.
Red Bear mud skipper people.
You're right. You're right.
They're still keeping the office from it.
So what we're doing at DePuy Capital Group is we are a fairly new startup real estate investment firm and fund. We have a private investment fund that our private or capital investors place their capital with us, and we manage that capital. And what we're doing is we're really dealing and working with real estate investors. So we offer private loans to real estate investors to purchase properties like fix and flip properties, even some buy and hold properties. And we offer a product called transactional funding for those real estate investors who are doing wholesaling and they need that capital to be able to close that A to B transaction. And this is really a culmination of a lot of
Before
years.
you move
Yes,
on,
ma'am.
can you break that down real quick? Because I understood what you said, but the person listening might not know what you just said.
Okay. So the best way I can explain it is if any of your listeners have ever watched HGTV or any of these shows on
We're
TV
going
where somebody
here,
buys a
are
property.
we? This is where we're going?
TV? No, this is radio.
Yes.
This is radio.
I'm just saying, like HGTV is not the real world, but okay, this is your story. Go ahead.
Exactly. I completely agree with you. But people look at that and they think that is. So these fix and flippers, that's what they're doing. They're buying these properties at a discount. They're typically in need of repair. They go in, they purchase the property, and then they rehab it or renovate it, and then they turn around and sell it for a profit. And so that's your fix and flip crowd. Then there's some people like who Jeremy works with on the rental. You have real estate investors who buy properties, and then they hold them for long-term rentals. And with the past couple of years, with the advent of Airbnb, VRBO, these short-term rental platforms, a lot of buy and hold investors are dipping their toes with their properties in the short-term space. So we cater to those individuals, those real estate investors who are looking for loans on those properties.
Now, how much does someone need for something like that as far as a down payment, which is what we refer to in our world as LTV or loan to value, but how much does somebody need to purchase that, and how does that work?
Yeah, excellent question, Katrina. It can vary on the project. It can vary on their experience and how much we've worked with the person. What we typically see is when someone comes to us looking for the purchase money on a property, we will loan them up to 80% of the purchase amount. That will put them at an 80% loan to value, and that would mean they would have to bring 20% down to the table.
Are you guys looking at the after value at all, or if the value is higher than what they're able to purchase it for, or are you disregarding that, like most lenders?
Absolutely, great question. We do consider after repair value. We are in the investment space, and we know that a lot of real estate investors are looking at, hey, I'm buying the property for $100,000 today. I'm going to put $50,000 of work into it, and in 6 months, I expect expect it to be 225 to 235,000, let's say. So we do take into consideration that after repair value, and so not only will we loan them the money to purchase the property, we would like to also loan them the money to renovate the property. So they can get almost 100% financing less the money they have to bring to the table.
Which is 20% of what, the after repair value?
No, ma'am, it's 20% of the purchase. So, for instance, in the situation, so in the instance of the situation I just explained, if the property is being bought for 100 and the renovation's 50, we would provide a total loan of 130,000. Of that 130, 50 would be dedicated to the renovation, and then the other 80,000 would be given for the purchase. They would have to come to the table for the 20% of the 100,000, so $20,000.
So how is that money given, and in what, is it distributed like a loan? And is it, are they required to have a licensed contractor? Can they do the work themselves?
That's a lot of questions.
I know.
Those are excellent questions, and I would definitely, this is where Leo comes in, and his expertise in the industry helps someone like myself. I'm not a contractor. I've never swung a hammer except for to hang, picture frames at the house. So we rely on people like Leo to go in, and what he will do is he'll go in and say, let's take, for instance, this scenario we're talking. If the borrower comes to us and says, it's going to be $50,000 to renovate this property, I'll hire Leo. Leo will go out to the property, and he will confirm, is it going to take $50,000 to get this property up to a livable standard? That's called a feasibility study. So they get us a feasibility study, and then after everything is checked off and confirmed as far as the cost and the scope of repair, as the real estate investor is moving through the project and they're spending capital to get the property fixed up, they come to us, let's say, after $10,000, and they'll say, okay, I'm ready for a $10,000 draw. We would send Leo back out to the property, and he's going to go out there and take a look at it and say, yes, they have completed $10,000 worth of work. Mr. Epperson, you can disperse that $10,000. And so that's the process. That's the life cycle, so that the investor does not have to have a capital outlay, or they don't have to spend all $50,000 first before they get reimbursed. It's, as you said, a draw process.
Question for you. So what does your interest rate look like compared to a normal loan?
And the fees.
Yeah.
Yes. This is always an interesting conversation.
Good question on that one. We just got yes.
Listen, here's the thing. There's some risk associated with what they're doing, so it's not going to be free.
Right.
Fair enough?
That's correct.
Do you want to range on the fees and the rates?
Yeah, absolutely. So for real estate investment loans, typically these are short-term loans. So we're not looking at a 30-year ability to make a lot of money. We're looking at 6 to 12 months, typically at most. So our fees typically start off at around 8.99%, and that's not driven by credit. So fortunately, with our underwriting, the way that we look at a loan and look at a property is we are focused on the asset itself. We are what they call asset underwriters. We also take into consideration the borrower's experience, what type of team they have behind them. Are they using a licensed GC, or are they trying to go at it by themselves? All of these factors actually will dictate the type. We do allow both, yes, ma'am, depending on the scope of work. Obviously, if the house needs a complete gut job is what we call it, where they tear out everything, electrical, plumbing, replace the roof. I mean, you're basically hitting your 4 major components and HVAC, then they're going to need a license, obviously. Either they or they're going to have to hire a general contractor. Now, if they're getting in there and they're slapping some paint on the wall, replacing the carpet and hardwood floors, no permits are needed for that. So a lot of that depends on the actual scope of work. All of that actually dictates what the rates and terms are going to be. Again, on most of our terms, when we say the term of the loan, we're typically talking about the time frame. So our terms are typically 6 to 12 months. We do have extension options if a project goes long, which it does happen. And then the interest rate is interest only. We're not doing annualized schedules, so they're not paying principal and interest. It's interest only.
Is there upfront fees? What do those range?
Yeah, so the upfront fees can vary depending on how often they do business with us. So, I don't know, Katrina, how involved you are in the real estate investment space or the world, but there's this term that gets thrown out there. People want to, quote unquote, build a long-term relationship. And it's a nice little comforting thing for a lot of people to say, and they want to hear that and they want to know that. But to get to that point where you have a good, solid relationship with your lender, that takes time and it takes experience. And so our points typically start off anywhere from 3 to 4 points on the capital when they first make their loan. After a few loans, those points can drop, and it can drop all the way down to just 2 points. So for hard money, private money loans for real estate investments, only paying 2 points for the use of that money and being able to leverage is fantastic.
Yeah. Edwin, thank you for your time. If the person listening wants to get any information, we'll get you guys connected. Our author number is 813-377-2775. Just text Edwin to 813-377-2775, or you can call that number, 813-377-2775. When we come back, Leo, chime in on what you're looking for during your inspections.
By the sound of money being counted.
That's a lot of dollar bills, yo.
Pick up where we left off.
Yeah, Edwin was talking about something very crucial to his process, which was the actual act of doing the initial inspection.
Yeah, go ahead.
So
I'm
during
playing my live stream here.
So during that initial inspection, what we're looking for is basically, a lot of times we'll have a contractor invoice in hand, and their pricing is generally good. But what ends up happening is you have these guys, they go out and they'll get 5 bids, and they'll get a family bid that is really low compared to the other 4 bids. So in order to protect companies like Edwin and Jeremy's, what we do is we say that this pricing isn't average contractor pricing. This is depressed for some reason. Here's what an average
Sarah's on the phone.
And did he actually say that they can do some of the work themselves, as long as it's not like the 4 points, right?
Well, they can do some of the work themselves. I mean, a lot of times with investors, they are general contractors.
Okay.
So it's level of comfort, level of skill of them.
Got it.
But the 2 areas we find that generally, when we're asked by Edwin and Jeremy to do these estimates that fall flat, area number 1 is going to be the pricing just isn't what the market would do. So in that scenario, you've got your brother who's a GC who's giving you a family price. Well, if he gets too busy and he decides to do other work and you have to find someone else to take their place, you need to be
What's it going to cost you to do it?
on average pricing.
Yeah.
The other area we find is the scope just isn't complete. We had a large project. This was going to be great. It was a very large historic house. They were going to convert it into a quadplex. And they had all the quotes and stuff to convert this to a quadplex. And we're talking like $100,000 plus house for Edwin and Jeremy's group. Turned out they didn't put any of the foundation work under the house for the conversion. Because when you're changing the load-bearing walls, you got to move piers, you got to reconfigure the crawl space. Well, that was going to be $30,000 worth of work. That was not in the estimate. So we brought that to their attention, added it to the estimate. Deal blows up because now it doesn't make sense financially.
Right.
So those are the 2 areas that when we're inspecting these deals, on the front end we help. And on the back end, it's just merely, is the contractor, you got your brother, needs some
Sarah's here.
money, so they might just throw extra money in the draw request, and we're just making sure that you're only getting paid for the work you do.
It sounds like, especially converting that big house to a quad, I mean, that sounds like a really big undertaking.
Yeah, it was. It was like over $100,000 to do that. So when we were out there, we were really, and I was super excited about the project. I really wanted to work with that GC. I was in favor of it. So when the deal blew up, I was very upset because I really wanted the property to move forward. So
You could have bought it.
well, no, I knew the numbers and it wasn't going to work.
So, and that's a great segue into Sarah, which, she does do some of these things, but I imagine that Edwin that would be outside of the scope of what Sarah could do. Welcome, Sarah.
Good morning.
So, what's going on in your world of the mortgage market and the arena of the 0% interest rates that we talked about last week?
So it's been a little bit of a roller coaster this week. Okay, this
Like
week.
the stock market, huh?
Down
Correct.
30,
Yeah.
up 15, down 10, up 5.
So I'll give you some of the highlights. So mortgage applications are down 30%, which was expected just due to the coronavirus.
And the rates,
they
right?
fell-
The refis, too, right?
Correct. 34% on refis. They fell most drastically in New York, California, and Washington, obviously. The jobless report came out this week, and 3.28 million individuals filed for unemployment for the first time last week, which is huge. The silver lining on that is the House is going to pass a new bill today, which will extend the term of benefits from 39 weeks up from 26 weeks if needed, and they'll receive an additional $600 per week on top of the normal benefits they would typically get. So the jobless claim report was huge, and basically the stock market still actually did a little better. It's like it shrugged it off, even with that information. So that's what we're dealing with. Some things that are coming down the mortgage pipeline are, we're seeing this week a lot of changes to include the pause of what are called non-QM originations.
Explain
Those
what
are
that
going.
is, yeah, for the person listening.
Sure, those are going to be the lenders that have the niche programs, that don't conform to Fannie, Freddie, HUD criteria. For example, those borrowers are documenting their income with bank statement deposits rather than tax returns,
The
or
person
perhaps they had
listening is probably thinking, wait a minute, I thought those loans were gone.
Well, they actually came back and started becoming popular. They do come with larger down payments and higher interest rates. But again, we're seeing a pause in those programs altogether.
Let's set
Those
the
are
record straight. Those have always had a need, right? In the mortgage market,
Yes.
in the lending arena, they've always been a normal product. What they relabel them to is a little different in today's world, and so lenders are getting more conservative. But for the person listening, I just don't want them to think that what you said is 2008 again, because I would totally disagree with that. We're going to have a
Correct.
correction, but it is not the same lending arena as it was back then.
Correct. What we're dealing with right now is just the tightening of credit across the board. So what we're seeing this week, again, is the pause in the non-QM originations, so those folks qualifying on bank statements or that had a recent adverse event like a foreclosure or a bankruptcy or a short sale. Okay? We're seeing a reduction or an elimination of jumbos from a lot of investors, including banks. And the very latest issue that came out yesterday, and that's the liquidity of Ginnie Mae securities, which is the credit risk associated with FHA, VA, and USDA loans. As a result of that, investors are starting to tighten the credit box there. We were given a list of changes yesterday that are being implemented immediately where government loans are concerned. So we are unable, as a direct lender, to approve or lock FHA, VA, or USDA loans right now with a credit score that is less than 620. Now, typically in an FHA program, I could go down to 580, correct. What you're going to find,
What about the
and
no
I'm
scores?
seeing
Any impact there on the no scores?
a no score defaults to a 580, so a huge impact there. Okay.
So wait a minute, Sarah, because this is the same station Dave Ramsey airs on, so I just want to be crystal clear. If you have no
Sure.
credit score at all, that's going to default to a 580 and we cannot manual underwrite, is that right?
Correct.
Oh, wow.
We cannot. And every investor is going to have a different set of rules. What I started to say is I saw some alerts come out late yesterday afternoon from the wholesale side. So if you're a mortgage broker or a correspondent, they're being capped at a 680 credit score. So I would urge any borrower currently in process for an FHA or a VA or a USDA loan right now to contact their lender and make sure they don't need to be reapproved and that their approval is intact. Additionally, we're going to have a debt ratio, if your credit score is between 620 and 660, that is lower than 50%. And typically you could go a little higher than that in a regular FHA loan.
So it's more
And
conservative.
correct. And then also, you're going to have a debt ratio that's cannot be over 50%, and you're going to have 2 months worth of reserves. You're going to find that how these guidelines tighten is going to vary, where credit scores related, manual underwrites are related, things like that from one investor to the next. So again, I would urge anyone currently in process for an FHA loan, VA or USDA, to contact their lender and make sure they don't need to be reapproved. I actually had a realtor message me last night. She was a listing agent on a property. The buyer's loan was FHA with a 630 credit score, cleared to close, and they were informed that it could not fund because the investor could not sell the loan. So what that tells me is
for so
correct.
you can go to a different bank and get a different loan. It's not saleable.
Well, I mean, they could go to another lender. For example, I can write loans down to 620. So that was the reason I got that inquiry, okay? HUD is basically rolling back and looking at what books of business are riskier than others. So that's why you're going to see one investor can write a 620 score today, whereas another is capping at 680. Definitely want to check that out. But those are some of the things, and coming down the pipeline, and this is brand new information. What that tells me, though, is that on a clear-to-close loan with a 630 credit score, these changes are being implemented across the board, effective immediately, and case numbers and things like that, interest rates that were already locked in are not being grandfathered in or honored. So that could present a big problem. If someone is
So
currently
this is something that's all the way down to the wire, clear to close, ready to be
Correct.
issued, and you're telling me, boom, the hammer just dropped, they can't close, right?
correct.
Sounds
And again,
late.
well, I hear you, and just to back up what you said, I believe this is temporary.
Right.
Okay. But again, it is currently happening now. We are having to readjust the way we do business on a daily basis.
Have banks started freezing line of credits, or is any of that going
Some
on?
of the so they're rolling back on, for example, home equity lines of credit. Some of the more aggressive banks were lending in second position up to an 89.9% loan to value. They're rolling back to 80%.
Okay, now they
Correct.
want 20% equity. And are they?
Correct.
What about for existing lines? Are they cutting? Can they cut back someone's existing line? Can they freeze it for no reason?
They always have the ability to do that. That was something that happened left and right back in 07 and 08. I haven't seen that happen yet. I did have a client yesterday that had a commercial line of credit, and that was completely frozen, but that was a completely different market than your average residential home equity line of credit. So I haven't heard anything on that, but I'll do some homework there.
Okay, sounds great. And what can someone expect in the mortgage arena right now in terms of rates?
Not pretty. Very hard right now for us to price an interest rate, a note rate that is what's called par or has.
Repeat that.
Okay, so it's challenging right now in both conventional and government markets to price a loan so that there are no points or costs associated with the rate for the borrower. I ran a scenario last night.
Hey, Sarah, why don't you hold that thought? Let's chat about that and sum it up real quick when we come back from this quick break. If you're curious
Sure.
what the heck she's talking about and how that could relate to you, call us or text us at 813-377-2775.
Sarah from the mortgage.
No, not necessarily. All right, Sarah, so sum that up. What the heck were you saying? People still getting money or what?
So we're still busy. Phones are still ringing off the hook. We have several clients interested in refinancing, but our recommendation is to float right now. So we're basically preparing those
Float
loans
right now means what? Not to lock your interest rate or not
to
get a
not
loan yet?
lock in. To not lock in right now. Correct.
Tell them to make application with you still, submit all their stuff, and then wait.
Absolutely. Absolutely. We're getting the loans processed. We're getting them parked in our pipeline so that when we can start grabbing improvements, hopefully in the near future, we'll be ready to go, and it'll be a smooth process.
And you are still closing and funding transactions, because you didn't answer that, but I want to make sure the person listening knows.
Absolutely.
Even though credit's tightening, money is still being lent.
Absolutely. Yes. And so you're going to want to work with a company like mine at Summit Mortgage, where we've got the liquidity and the warehouse lines to accommodate a large pipeline. We're a national lender. Some of the smaller banks, that may be shrinking a little in that respect, and that's why they're becoming a little bit more restrictive on the credit criteria with regards to what they're willing to fund.
Yeah. All right. Well, Sarah, thanks so much for chiming in today. What rates are we looking at roughly on a 30-year arena? Can you give somebody an idea? This is where the pricing's getting a little funky, but...
So it's challenging to hit what's called a par rate, which is an interest rate on a published rate sheet that has no cost associated with it being passed to the borrower. I looked at a scenario last night. Again, this was based on last night's last market update, and a $200,000 purchase, for example, if you had a 680 credit score and wanted to put 5% down, came with a note rate of 5.125, an APR of 5.911, and points, 1.3% in points, which based on that transaction would cost almost $2,500 in additional cost for the rate. The same scenario, going FHA, with a 4.875% note rate, a 5.981 APR, and a cost of almost 1%. It was 0.905 in points.
The federal government's really going to have to lift that permanent mortgage insurance on FHA. With the rates and what they're doing, they're going to have to lift that, because there's not a lot of incentive for people to go conventional over government. All right, so we'll be back next week for another market update on the rates. Thanks so much, Sarah, for chiming in. Feel free to bring any scenario you want weekly. Let's just chat about what you're seeing and what's going on. If you got any questions, you want Sarah to run your numbers directly, 813-377-2775, 813-377-2775. All right, so real quick, couple last things we want to cover is I want to give you guys a market update so you know what's going on, because, Leo, you made a comment before the show about what you saw published in, was it the Wall Street?
I'm not going to mention the local newspaper.
Okay.
I'm not going to mention the
Times
or whatever it might have been, giving data from the beginning of March saying the real estate market hasn't changed since the world changed on March 11th.
So what I'm going to do is give you guys a real-time market update, and what we've done is we've modified our numbers that we look at for the last 7 days, and every Friday morning we are going to pull this. So that's going to avoid that delay that we're seeing of almost 45 days by the time we can pull the data in Florida Realtors, okay? So just be mindful. There could be someone that like an agent that has not logged a sold showing yet. There could be somebody sitting on listing paperwork that's not yet live in the MLS. Those numbers will not be accounted for, obviously. But this will help you get an idea on what the market's doing. It's what we do to keep our thumb on the market and get an idea of the pulse, so what's happening. And so the number of new listings, and by the way, I modified this for the 3-county area. It did not include Hernando, which is also included in Florida Realtors' number for Tampa.
But Florida Realtors spent the last year pushing Hernando on us.
Well, here's the thing about that. For one, it's a totally different MLS, so I think it's just ludicrous that they even include it in that. It's a totally separate MLS system that we have to pay for separately outside of the one that serves Tampa. Most people don't know that.
They use actual bulletin boards on the side of the highway for their listings.
No, it's just a different MLS. And so
Windows.
Send you a
Yeah.
postcard
Windows,
in the mail.
postcards.
So I pulled the data from our local MLS in the Tampa Bay area. So this is going to include the counties of Hillsborough, Pasco, and Pinellas only, okay? So if you're listening in our neighboring counties like Hernando,
And you're on your horse
or
and buggy on the way
Polk,
to the general market.
or Manatee, or any of those counties around where we know you guys can hear us, we can pull the data for your county. If you're interested in information, I can pull it any way you want, even by your zip code. But the number of new listings that we had in the 3-county area was 1,182 listings. Now, Leo, you're the numbers guy. Where do you think my numbers go next, or where do your numbers go next? What do you look at next? It's not in order either.
Yeah, and usually if I want to compare sold to new listings.
I actually look at my brain. I'm looking at the new listings coming to the market, right?
I want to see what was
because
sold.
we're gauging what's our absorption rate.
Yep.
I'm looking at the number of pendings.
Yeah.
So that number is 1154 compared to the 1182 that went new listed. So that tells me our market's still moving, right, in terms of the number of listings being listed and the number of buyers putting in an offer. Now,
That's almost the same.
I'm also going to look at the number of sold listings. So our sold listings is 1269. That is still higher than everything new and everything pending. Now, these numbers will change in the future, in the coming weeks ahead. That's why we're going to report them every single Friday morning, because you will start to see the number of sold listings go down, and you'll start to see these other numbers start to move around, okay? That's that absorption rate we've been talking about for a while. We were right about 2% when the market was still on fire, and it's still pretty active when you look at it, right? But number of new listings, 1182. Number of pending listings, 1154. Number of sold listings in the last 7 days, all this data, is 1269. And so from there, we're looking at a couple other numbers. What number do you think I should look at next?
Oh, temporary off market.
Actually, I'll look at the price reductions next.
Yeah, well, price reductions and wow, that's almost equal to the number of listings.
It is, and it's actually higher than the number of pending listings. So what does that tell you? Our market's ramping up for a little bit of a dip. It's preparing for that. And I think it's going to live beyond the coronavirus, right? Because we're overdue for this correction. We've been talking about it for a long time.
Well, I mean, it has to live on past the coronavirus because it's not like the virus is lifted, I can go back to work tomorrow, and all of a sudden all this money I'm missing for the last couple of months, it reappears.
So this temporary off-market data, that means the listing is active, but it's not open to the public right now for showings. We're not actively marketing it to sell it. 396 of those in the last 7 days is very high.
Cancels is also through the roof as well.
Yeah, 211, withdrawn 92. 5 of them actually leased. That's a little bit surprising, but they did. 48 expired. We're going to have some of those pretty normal. But this is your 7-day market watch. And so we're going to continue to give you these numbers every single week. It's interesting. I've been following these for a while. And yep. We'll prepare for that in the coming weeks ahead. This is Tampa Home Talk. Our author number is 813-377-2775. Call or text 813-377-2775. And stick around for hour number 2. We're going to talk about how to clean your home for this coronavirus thing. Wherever you live, we'll fix it.